Ladies and gentlemen, welcome to the SoFi Weekly. As always, we have the great and powerful SoFi shareholder diamond handsing through his position, Roy Crossroads.
How's it going?
Doing very well, man. It feels great. It feels great to be a SoFi shareholder, hitting new highs, not missing out on any potential gains.
Yeah, I mean, like when you know what something's worth, it's easier to hold on to it, highs or lows. I will take profits at some point. We'll maybe talk about that tonight on some options, but haven't yet. So another 52-week high this week. Not bad.
Yeah. No, it's actually not just like 52-week high. I think like what's his
You're
name?
right.
It's
Yeah,
something
yeah.
like 150 weeks, something like something crazy, 165 week high.
Yep. Yeah,
Jeez.
it's been a while since it's been up here. So
It didn't pay the heat bill, Roy. Yeah, he doesn't want to sell any shares, so he's saving up.
I should turn off the light again. No, just kidding.
He knows a bull run when he sees it. He's putting every dollar towards it. He could be cold.
Yeah, it's a cold snap. So it's like we don't have an opportunity to like even use blankets or jackets often here in Houston. So I'm like, was wearing my Palantir jacket out on a bike ride today. That felt good. And cozying up, drinking. I've not drank any hot cocoa, but thinking about it and a blanket. I'm like, this doesn't last long. We get like 2 months of pseudo winter and that's it. So,
Tevis, how's it going, man? Sorry, I know you were late counting profits. How's that going?
Going well. How are you guys?
Doing well. Make sure that your mic is correct. You came out very loud there. I'm sure it might be. Maybe it's just.
It's correct.
Oh, okay. It doesn't sound as bad. Maybe it was just an initial spike.
I might be soft too. Let me know if I need to turn up gain.
Okay. Tevis, so you put in an interesting tweet that I talked about on my FinTech Frenzy. I just want to jump right into this. You said,
did you?
You're seeing a lot of screenshots showing off people's large gains, and that these are sort of telltale warning signs for you that things might be getting a little too hot. Do you want to explain that a little further?
It's like a public service announcement. Don't read into it, because in 2021, people were flexing all of their paper gains and they were getting super happy about it. And in retrospect, we can now, line the, timeline up, the order of events, and see that we were close to a top, or at least a local top before a pullback, especially in some of the names that have had like parabolic moves this year. If you're out there and you believe in a company long term, then that's one thing, and absolutely hold on to that position because you can make multi-baggers. But at the same time, if you're waking up and you're counting down the minutes till 9:30 and you're getting euphoric because you bought, I don't know, Rocket Lab, just as an example, at 5 and now it's at 27, and you're screenshotting how much money you made, it's like, well, if that pulls back to 15 and you're going to feel like crap, then it's probably a sign that, hey, we're overextended and you should consider taking some of your gains and locking those in. Again, it's something that I wish I read in 2021 because I was that same person. And this time around, I'm being much more reserved. Like, I just wrapped up my portfolio review, and I'm going to put a tweet out over the weekend around my portfolio composition. And I have 27% of cash right now, just because I think that there's going to be opportunities. And a lot of that cash is just from stuff that has run up incredibly. I'm still holding on to my core positions. I'm not really, I didn't trim my core positions. I'm consolidating. But at the same time, I don't want to be caught on the downside if there are pullbacks and I don't have, dry ammo to jump on them.
Roy, are you just getting out a pen to write down to get a little margin on Monday? What are you doing?
Yeah, going all in. Tevis is maybe going a little cash, so it's time to be 100% all in. That is the play for sure. So what are you selling, Tevis? Because I'm buying.
Actually, I'm actually going 127% in. If he's 27% cash, I'm going to go 127 in.
So
that's a good point.
So don't get me wrong, guys, because I'm also selling options on a weekly basis, and the cash is something that I use on a weekly basis for cash secured puts, just because I don't want to do cash secured puts on margin. So I want to run both sides of that wheel. If we have a green day, I think I've talked about this, and I think I talked about it last week. But if we have a green day, I want to sell covered calls on my positions. If we have a red day, I want to sell cash secured puts and have that cash on the sidelines to be able to use as collateral. And so the cash is dual purpose from that perspective. It's not like I'm a, doomer or spreading FUD or whatever and thinking we're going to go into some like dark timeline where I'm going to be, 27% cash because I'm waiting for a market crash. Like, I'm using that cash actively, and I'm trying to earn 1% a week on, that's worked out so far. Most, many weeks in the future, I don't think I'll be able to earn 1% a week, but my point is the cash is still making me more cash.
Yeah. And locking in a little bit of gains that are actually potentially realized rather than just paper strong. No, I think it's sorry, go ahead, Roy.
I was going to say, I had a similar post to Tevis after discussion on that ridiculous Nike post that I did. I've seen this a little bit over the last few weeks, and it seems like it's heating up. Tom Lee even had a post like 3 weeks ago noting the same thing. And somebody had said that they thought that 40% up year to date was like terrible and abysmal. Like, everybody should be unhappy with those kind of returns and should be chasing multiple 10x opportunities every single year.
Is this a well-known person on X amongst?
No. But I saw this actually when we neared a local top back in February, where it's the same thing. And there was a discussion back then about like they had said SMCI when it was like at $900 before split, of course, was a safer play, that and Mara, Riot, some others, than PayPal at like 50 something. And I'm like, that's the dumbest thing I've ever heard. We are probably going to get a pullback. And of course, I think the day after that, ironically, SMCI came out with like fraud stuff, and it just like crashed. So I was like, that's one of those feel good moments where, I don't like people losing money, but when, and I'm not seeing it, a lot of people sharing screenshots like Teva said, but the bigger indicator to me of a pullback, this isn't the end of the bull market rather, but just a pullback, is when people are posting 200% gains. And there's a lot of people that are up, 200% year to date, and that's awesome. Congratulations if you're one of those in the comments. But there's folks that are like, oh, I only have, 50% up year to date, or I'm only like 75% up. And, I wish it was more, but it kind of sucked this year. It's like, yeah, we're due for a pullback.
And I think if you're truly bullish on your companies over the long term, if you're being honest with yourselves, you're going to welcome pullbacks because they're healthy. Because if you have a parabolic move and you go into this like super overbought, bubbly territory where it just doesn't make sense from any metric, like, that's going to do you harm over the long run, because it's going to take a while for the fundamentals to eventually catch up to that valuation. And so, yeah, it's great that some stocks have, like even SoFi, right? It's done a double in like 6 months, or over a double in 6 months. And that's fantastic. But at the same time, if it went flat for, 2 months and we wake up and it's February 1st and it's still at 16, I'm not going to be upset about that. If we go to 20 tomorrow, I'm not going to be upset about that either. But my point is like, if you're in the company for a long time, you want to have a gradual increase that's correlated with the fundamental increase. You don't want to have something that deviates too far away. For SoFi, we had it where the fundamentals were growing and the stock wasn't moving for 2 or 3 years. That wasn't good. But you also have the inverse, right? Like, Roy, not to pick on you, but Palantir, for example, right? Like, the fundamentals have increased, but the valuation of the stock has gone up 6x. This company has not gone 6 times better, right? And so eventually, all I'm saying is it's going to take time for the actual underlying company to catch up to that valuation.
Well, let's not assume. Has it gotten 6 times better, Roy?
If you're looking at the actual metrics as far as what they've earned, no. If you look at the actual TAM and opportunity,
if you look at the confidence of the investors that hold it, then yes.
Like, for we don't want to. I don't want to derail too much. We've done this before with SoFi Weekly, and we end up talking a lot about Palantir. I'm prepared to take some gains in January on actual stock. So that's where I'm at with Palantir. And I've not before because it's one that I want to have long term. I've taken it off of leaps, but that's it. And maybe we'll talk about that as far as like it relates to taking profits on options versus stock and our strategies. But no, like the company is phenomenally better than where it was. And it was undervalued, frankly. I was telling you guys, and I think, we weren't laughing at me in derision or anything, but just kind of chuckling when I said like 17 was going to be my all-in point when I was trading in its 20s. Not all in, but like I'd go back into 90% Palantir. It's not because like if you look at the PE or if you look at the price to sell, it's like, oh, well, it's overvalued there. Wasn't overvalued. It wasn't cheap, but from what I can see, the company actually provides and what they're capable of doing, and their strategy is actually working. It's very, very differentiated, and it's in the middle of the secular shift towards AI. And frankly, there are imitation is the most sincere form of flattery. Like Microsoft came out with a product where they like basically copied the wording and strategy of Palantir without the actual code.
Foundry.
It's still competition because it's like Microsoft's strategy is like good enough, not necessarily good. So there's some competition, but realistically, they're a unicorn. Like they're a one-of-a-kind company. There isn't really any real credible competition at scale. There are some startups maybe that kind of harder to like Helsing in Europe, and then there's one another Alex up in California. I can't remember the name of his startup, but I would say like where the company is in my mind is worth about 4 times as much as where I thought it was a little over a year ago. Just because there has been a fundamental shift, and it takes a while in a business to business environment for those to actually matriculate into cells, because you have to work out a contract, and their sell cycle has shortened. But that's one of the things with Galileo and the tech platform is sell cycles for business to business. If it's a large contract and a large subscription, a large deal, it takes a little while to work out. So yeah, we'll continue to see, I think, the acceleration of the business. Is it going to grow like 50% year over year? Probably not. It could get in the 40s. It's like 50-50 to me if it will. Good chance it gets into the like mid 30s. So that would sits there for a good long time and remains very, very expensive for a while. It's also due for a pullback. It just is.
Yeah, that's exactly my point, right? It's a deviation between what the stock is doing and what the fundamentals are doing on either side. Like if the stock is not moving and the fundamentals are, or if the stock is moving and the fundamentals are not, ideally you want to have them move in lockstep. And that's all I'm trying to say, right? Like stuff is going to pull back over the next couple of months, maybe not as a broad market pullback, but individual names are for sure going to pull back because people are going to take profits. They're going to try to compound those profits by cycling them into different names. If you get high on this idea of 40% year to date is not good enough, and you want doubles and triples year to date, and if you bagged, Rocket Lab or Palantir or whatever, then you're like, okay, cool, I caught a 6x or a 5x or whatever. Let's take that money and move it to the next Palantir, the next Rocket Lab, the next whatever. And so my point is that you're going to have select names that are going to be pulling back over the next several months because it attracts a certain kind of short-term trader mentality because of how much they've gone up.
There's some of that. I think that there's a lot of danger if you're not a trader in doing that. That's a common mistake that retail makes, is that it's not winner's fallacy. It's something like that, though. Gambler's fallacy?
Hot hand fallacy?
Hot hand fallacy.
Yeah, hot hand fallacy. Exactly. Yes. Where you're like, oh man, it's everything is working for me, and I'm a god at gambling, or I'm a god at investing. In reality, is you may be quite good, but it's a bull market, and even in bull markets, there are pullbacks. Even if you are a gambling god, you're going to take some losses, like you just are, and so you have to be careful to not like double down every single time. The tendency in retail, and I know this because I've done this before, is when you make a massive game like 2021, AMC did very, very well. I didn't lose all the money that I gained on AMC. Well, I did eventually in 2022 when the bear market really, really hit, brought Palantir all the way down to like $6. I played stupidly in the market because I was like, oh man, look, I did great in this. I'm going to do great in that. So just be careful. Know your strategy. If it's working for you, and 40%, if you're at 40% year to date, it's working for you. Continue to refine that. If you need to make changes, do that. But don't think you need to find like a 10x like every 6 months. You might be able to do that for a little while in this environment, maybe for a few years. Probably not, but there's a danger there.
Yeah. Now, with that said, SoFi is still going to 20 end of year. Like, let's just level set here, guys.
Yeah, well, do you have any
covered calls? So yes.
Yeah. Do you have any covered calls sold out right now for SoFi?
I have 19s.
There we go.
That's good to hear. Then 19s for when?
I'm not going to tell you when.
I know when, but I'm not going to say. But I can say,
dude, you don't want to hold the legacy back.
End of year.
Part of you saying it is what makes the legacy true. You're telling over 300 people in this chat right now you don't want them to get to 19.
How about this? I'll tell you guys in the after hours.
I don't mind that.
So if you guys want to know, you guys just subscribe.
Okay, so that's so funny. What's called? Someone asked what the PEG ratio for Palantir is. It's just right around 3 times. All right, moving on.
PEG on like SoFi, on Nubank, on Palantir, like newly profitable companies, it's misleading. Now, it usually is misleading in a positive way in a rapidly growing company.
It's a 5-year expected PEG.
Yeah. No, I'm just saying it's not the best measure. Price to sales is actually a better measure, which is obscene in Palantir right now.
I never ever use price to sales unless I'm looking at comparing companies that do the exact same thing.
Yeah, well, yeah, and they're a unicorn, but you can compare like sector, so you can look at SaaS, and it's obscene for Palantir right now. Some of it's justified, a lot of it is speculation and trade. But in these names, like if SoFi gets a pullback, well, let me just say this for Palantir, like a lot of people are like, oh yeah, I'll buy Palantir when it gets to the 20s again. It's not going to the 20s again, barring like even in World War III, it's like has a military aspect to it as well. Alien invasion maybe would put it into the 20s. Maybe could it get in the 30s? It could. Chances are it's not going to go as low as some people are thinking. Like there are so many people lining up that want to buy it, and I know there's always people that say and then they don't pull the trigger. But a lot of people, just because the stock was running, took a look at the actual company and they're like, okay, I see the interaction. So they're doing well on a lot of fronts.
That's priced into PEG though. I personally disagree with what Roy says about the PEG on new company, especially a 5-year PEG, and Palantir's been profitable for like 18 months or something like this. I think that's a perfectly acceptable, I'm not saying trailing PE or something like this. I would never use those metrics. I'm not worried about the fact that they're at those high multiples there because they're newly profitable. But 5-year PEG is I don't know. They have been sub 1 PEG all the way back at like Q4 of 2023. But anyway, I digress. We're off that. So there was a guy who made it very he encouraged us a lot to want to talk about options on SoFi as well. During these periods of highly volatile SoFi stock, how are you guys playing SoFi in option strategies?
Well, first, let me say with SoFi, as far as pullbacks, SoFi is also primed for a pullback. I think that we'll get a larger market pullback, maybe beginning of the year, could be earlier, could be a little later too. So don't be shocked. And I'm saying that with this in mind. Like usually when I anticipate that, I'll take something off the table. I'm about 4% cash now, so nowhere near the cash that Tevis has, both in quantity and in percentage. But I have not sold any options. I have not sold any shares. I don't plan to sell the shares. I usually buy. I don't have leaps on most of my positions. I only do that when I see a fundamentally undervalued company that's growing well, that checks all the right boxes, and I give myself plenty of time and have a pretty conservative strike. So I believe all of my leaps for SoFi are $10 strike. Most of them are in 2027, some are in 2026. That's pretty conservative, I thought. Of course, I was buying them when the stock was $6 and $7. Usually I will take profit on a run up like this. Right now, I just think that the stock has gone from fundamentally undervalued in almost every way that you look at, unless your name is Ram or something like that, or your last name is Baloney. But outside of that, like, it just was. And so now it's in, for me anyway, fair value territory. And I don't want to sell a stock that I have plenty of time with my leaps in fair value territory, unless there's a need for money. Like if we end up buying a brand new Tesla Model Y, I'll sell a little bit of SoFi. I'll sell some, probably across the board from all my positions, a nice even trim. Or, if some disaster happens and like I got to pay some hospital bill for some horrible thing that happens and I need $100,000, hard choices are going to have to be made. So, but yeah, for right now, I think that Santa Claus rally will probably continue for a while. I don't want to sell in fair value territory. Now, if we hit 20 and we're in January 2021, 22, I will take some off the table for options just because they're options, even though the soonest expiring ones are in 2026. I already did, by the way, lock in plenty of profits on another run up that we had of SoFi last year on options. So, I'm sitting pretty well on that name, but I am very happy to hold. That's just me, though.
Yeah, I think for myself, I'm not, other than the 19s, I'm not doing covered calls anymore for SoFi, simply because the premium is just not worth the risk you take on. And if you have to roll consistently, like indefinitely, essentially, then what's the point of even doing it in the first place? And the fact of the matter is, with the majority of my position, I'm just not okay to let it go at these levels. And so I am not treating it as a business. I'm treating it as a long-term hold for this particular position. And so I'm just not writing options against it. The 19s is just as a result of me having had to roll, like 15s he had, because it's just been going up like 8 days, 9 days in a row or something crazy like that. I do have a lot of
that streak. No,
maybe we did. I do have a long calls. Now, the thing that I am going to sell over the next several weeks is my January calls, because the time decay on it is going to become bigger and bigger. We don't have a lot of time until those expire. I think we have like 40 days left or something like that. And that's not all trading days. So I am up like 180, 190% on those. So I want to determine how many of those I want to get called on and have the equivalent amount of cash in my brokerage account mid-January. Those are $15. And then I want to determine how many of those I want to sell. And then I'll probably sell like 3/4 of them, lock in those profits. And that will be my capital. That's like all gains to essentially get called on the remaining quarter. If that makes
The other thing to keep in mind, if folks are using a non-tax advantage account, remember taxes. A lot of people, I think, might be holding off, like myself. That's one of the reasons, because it's like, hey, a lot of my SoFi position is in my Roth, in my IRA, some in 3 different portfolios, basically. But in my non-tax advantage portfolio, that's, I don't want to realize any more gains. I like the realized gain number that where I'm at and pushing it more. No, thank you. I'll wait till next year where I think taxes will look pretty good for me. So, yeah.
Yeah, Stephen talked about that also, not just from if you're holding some of these positions for long-term capital gains, like going from short to long, but also, do you think that under a new administration that these tax rates might also be lowered? So do you think there's a percentage of the market that's holding for potentially better rates, other than corporate tax rates, obviously?
Yeah, I mean, we have much certainty on corporate tax rates. As far as personal tax rates, capital gains tax, I know the one thing we won't be seeing is any more nonsense about taxing unrealized gains, which is the stupidest thing in history. It's absolutely ridiculous.
A scary time.
Yeah, maybe a tax on like the insanely wealthy when they're lending against it or something, that a percent of what they're paying. I don't know, but like that would just be a disaster. Right now, I don't know for sure, but I know that there's a lot of folks that are probably waiting until next year anyway. Because I mean, when you get to the end of the year in a bull market, typically one of the reasons why there's several reasons why the Santa rally is a thing. Part of it is a self-fulfilling prophecy. People expect it, so they buy in anticipating that, and then it causes it. Part of it is, of course, the Black Friday and Cyber Monday. These next 5 days, or we're in the middle of them right now. Usually this is a time where there's a lot more good news that's published in headlines, so that's part of it, macro fears. And then the other aspect is in a bull market, people have made massive gains, and they're like, you know what? It would be super nice not to have to pay taxes within 4 months. Instead, I can just wait 1 month, and then I've got 16 months because, April, or if you're even getting an extension out to October the following year. So yeah, they're buying themselves a lot of extra time if they want to.
Yeah. Tevis and I are just sitting, watching what's unfolding and getting zero benefits either way. Actually, potentially negative side effects from tariffs, but Canadians, eh?
I mean, I don't know. Like we're invested in U.S. equities, right? And so if Trump is like, "Hey, we're going to cut capital gains tax, we're going to cut tax on crypto," like that still pumps our bags. It's just like we can't benefit off of that because we're not in the U.S. But this
is a good strategy as well. Tax rates don't affect you if you don't pay them. Just kidding, though. Obviously.
I mean, if you like pick really terrible stocks and underperform all, like you can realize that against your income and up to a certain extent. So
yeah, the IRS has joined the chat. Yeah. Okay, so in terms of news, Roy, I think you put this in your title, dilution. Do you guys want to talk about this?
Wasn't that insignificant?
Like, it is insignificant.
Oh, yeah. Okay. Well, yeah, sure. Let's talk about
it. If it was significant, Tevis wants to hold off. Yeah, let's talk about this insignificant news. SoFi put out an S8 saying that they are bringing more common shares to SoFi stockholders, to the total pie of the market cap. Now, this does dilute it on a common share basis, but on a fully diluted basis, which is how you're going to get EPS or something along these lines anyways, this has already been accounted for. So it is insignificant and partially still a thing, but yeah, it's mainly just from my understanding, for current employee packages and plans that are being paid out over time.
Yeah, and it was known already. So, I mean, you can see it in the stock reaction. Sometimes the market will miss things like this, but this is one where they, maybe some people looked at it and just kind of yawned. It's not a big deal. If the stock was like at $7 a share, it wouldn't surprise me to see a sell off anyway, just because short sellers would be like, "Oh, sentiment," and they're diluting, and there'd be all these headlines about. But they can't do that at 16. It just doesn't work for them.
Do you guys remember how many articles and everything we got about all these fear-mongering stuff, and especially like Anthony Noto needs to resign type comments? Do you remember that?
Dude, we got Anthony Noto needs to resign comments as late as like September.
Yes.
Because they reported Q3 and the stock didn't immediately like shoot up after Q3. It was a couple of weeks delayed. And people were like, "Oh, Anthony Noto."
Like, have you not seen the actual results? Not just the stock price. I know, like, that's the easiest thing to do is just look to see what the ticker is to figure out whether it's good news or bad news. But that doesn't always tell the story at all. And sometimes the market can realize after the fact, "Oh, we done messed up. We got to fix that." So, no, part of that was, I think, just natural negative sentiment of folks that have been bag holding and watching everything else run, and it's frustrating, and just taking out their frustration, saying something that they don't necessarily mean or think. I do wonder, like, how much of that are, it's like the legal side of market manipulation. Not, there are certain things that hedge funds cannot do, but I mean, certainly like making a personal comment about like, hey, I think Anthony Noto is terrible. Crystal Point should be replaced. They should do a PayPal. I saw that, I don't know, like 6 months ago, where they just decapitate leadership and bring in new credible leadership because these other guys are shady. It's like absolutely ridiculous. But it's just weird how much attention that got. It in the midst of, at the time, and I still see senior convertible notes. Like if you Google, I haven't done this in like a month or two, but if you Google senior convertible notes in Google News or Bing News or something like that, you're going to see all kinds of different companies. Many of them more significant and massive than SoFi. I know we think SoFi is the center of the world, but it's not. And it gets like, there might be like one or two articles. If you're like, oh, Block did something like this, and so you search and research more on that, maybe it gets like a footnote, somewhere in the middle of an article about other things. Versus like SoFi is like, why in the world did SoFi get like headline after headline for day after day? And it was not just in print, but it was in video media. It's just like, okay, high short interest, there's something else going on here, and it's legal. That's the sad thing about it.
Yeah, I mean, it is weird. Luckily, short interest is coming down. They even covered again today, which was nice. I think it was like something like 4 million shares were returned. So yeah, it is. Hopefully we're on the other end of that. I'm actually not in agreement with Roy that we're due for a pullback. I think that like it could potentially happen, but I don't think that it's due to fundamental reasons.
The broad market or SoFi?
SoFi, particularly.
So what about the broad market?
I mean, potentially, but I also like, I can see that it does come down, SoFi, but what you're saying is that the market's going to pull it down.
Probably, yeah.
Yeah.
I think that'll be, there might be some profit taking too, at the end of the year, but like, I think the latest that I see a pullback, and I could absolutely be wrong, I've been wrong before, is inauguration day or the day after. That'll be like a sell the news type event. Just a lot of run up and expectation of the new guy getting back in, who is also an old guy, but
the new old guy.
Yeah, the new old guy. Got to have more of those.
Yeah,
and there's a lot of excitement, but yeah, the RSI. Well, I have not looked at the SPX. Where's the RSI at on the daily? Let me pull that up.
Well, you pull that up. I'm going to start talking about the next topic, and then we can get to that whenever you bring that up. SoFi's market cap as of the close is $17.8 billion. Does this excite you guys?
It's good. Yeah,
I'm excited.
RSI, by the way, is fine. So good news.
Oh, that's good. I am bringing that up because $18 billion of market cap is the entry requirement for the S&P 500. What do you guys think about that?
Yeah, they won't enter for probably somewhere between 2 and 3 years. But it's good. Like hitting that mark. I think it's inevitable that they do get in. The actual run up for S&P 5. Yeah. I mean, they do announce, I think it's December 6th. I can't remember the date. It's that first week of December. Who's going to be added next? The trade desk is maybe one of those. I know AppLovin is certainly on the list as a candidate, and Robinhood. I'm not
worried about SoFi until Robinhood gets in.
Yeah, I mean, like,
I don't think there's a chance we get in before them.
Block will also get in before SoFi, I think. Even as mismanaged as it is, it's either I think it's eligible right now, but it's like further down on the list. But yeah, I think Robinhood will probably get in. SoFi, they're just like, the problem is that there tend to be 3 or 4 names that are removed every quarter, and so there's 3 or 4 people that can get in. So there's a total of 16. SMCI is a special case, and hopefully they get removed for the shady company that they actually are. So 16 names. There are a number of like boring companies that I typically overlook that are eligible, that probably will get in at some point. And there's a whole bunch of SaaS companies and tech companies, and of course SoFi as well. And that's a competition that are eligible or became eligible this quarter, or like so close there. Workday is another one of those where I think that it's going to be tough for that committee to actually overlook those and pick SoFi. Can it happen? It sure can. I personally would not be betting on it. I would not be counting on it or even expecting it. It'll be a nice surprise when it happens. But we'll see that, I think, in 2026. Maybe as early, at the earliest.
Sorry about that. I was on YouTube reading a comment, and then YouTube Shorts started playing. What's it called? So I missed some of that due to my freak out that the audio was going to start playing through.
Did you guys see this latest short interest numbers?
13.89% or whatever.
Yeah. That's the lowest short interest since January of 2024.
Time for them to double down.
Shorts are getting their asses handed to them on SoFi, and they're covering en masse.
It's just stupid. Like, bulls are not the only ones that can get greedy. We can often hold on to a stock much longer and think that it's going to go up, infinitely. But shorts, like they can only go down so far. I know that, like, if they can push a company into bankruptcy, great. They, don't ever have to cover, and that's awesome for them. But SoFi, like in the sixes, dude, that's like if SoFi ran to 30 and I didn't take some gains, that's on me. Like, just if it ran to 30 before the end of the year, I would just be begging for a pullback at that point. So they got greedy, they got burned, they're covering. I wonder, and I'm curious what you guys think about this, is at what price level, let's say, before the next earnings, what price level when SoFi runs up to would you expect to see shorts doing the opposite, instead of getting out, doubling down and just saying, okay, SoFi at $100. Like, obviously, if it's $100, I mean, we might be short again. I wouldn't. I don't short companies, but
I'm still seeing short interest on the daily charts here. It says short interest was 11.57% yesterday. On Tuesday, it was 15.62%. So I still think they are. I don't know if you're saying like go all the way back to like 20% and like.
So I'm pretty sure what you're seeing, unless you subscribe to a service that guesstimates on the short interest percent, is the percentage of shares sold short, not the short interest percentage. So like in a given day, what percent out of all shares that were traded were done that way?
Yeah, traded short. Yeah, as a percentage.
So do you think, like, if SoFi shoots up, let's say to $25 by the end of the year, do you think that some of the that we'll actually start seeing short interest increase, or do they just continue to run for the hills?
I think it's actually the opposite. I think if we pull back to like 14, that's when you're going to get shorts doubling down, as opposed to if we jump up to 20. Like, I would see fewer shorts at 18 or 20 than I would at 14.
Yeah, I think it'll have to be a momentum switch rather than a price. Like, I don't think there's a price that'll make them want to double down. I think once we start dipping, they're going to double down. They'll just wait to see the first little off the top and then start to double down. What do you think, Roy?
I mean, I think that you guys are probably right. There, even for large institutions, unless they have multiple different layers, emotion does factor in, and it's way easier to add to something on the downside to short it. If it's going down, it's way easier to buy and FOMO into something as it's going up. A lot of people are interested in Palantir now, where a year ago, well, probably like 2 years ago, they were like, this is a scam of a company. And now it's like, oh man, this company can do everything. SoFi is starting to go through the same thing. Robinhood is certainly there too, where it's like, this is a shady company. It's terrible. No one's ever going to use it. And now it's during $40 and it's like, oh, it's great. Hims even. like him switches. It's like Dr. Jekyll and Mr. Hyde. Every other week, it's like this is the worst company in the world, and Amazon will destroy them. And this guy is like way too political, or you know what? They're going to take the whole freaking market. It's like, okay, nothing changed. It's a week. Celsius, you think so?
He's just saying that Celsius is gonna.
No, I'm just responding to Captain Crunch, who's commenting on it. Hims is, I think, gonna. So here's the thing, man. I do think this rally can continue because it's going to be driven by. Did you guys see the Ukraine thing today? Not to get political, but
yes,
like they're getting closer to like ceasefire and actually, stopping. And then the Israel thing and all of the sort of open threads of uncertainty that could potentially disrupt the market are seemingly being closed leading up to inauguration.
You're saying people are going to go back to sex. Hims is where it's at. Is that what you're saying?
No, I'm saying that what
you're trying to sell more dick pills? Is that what you're trying to do to us right now?
I'm saying there's less uncertainty in the market, so we could have a very strong Santa Claus rally. What?
Make love, not war. Is that what you're doing?
I mean, when there is, what Tevis is saying is when there's not geopolitical tensions, there's not wars happening left and right on the planet, that trade routes are open, things do pretty well then. Companies do well, countries do well, stocks do well. And by the way, don't besmirch Hims. I mean, like, look at Tevis's hair. It's like godlike. So,
hey, man.
Obviously the product works. So
it was not that way before.
Every $10 Hims goes up. I just look younger and younger.
Yeah. You know what people say? If you look at the early pictures of Elon to now, some people say he was an early subscriber to Hims.
What's the difference? Money.
And he has like freaking so many children. I think he's getting the full bundle.
That's true. You'd be a good spokesperson, I think, for Hims. But Tanner, when are you going to get into Hims, man? You need it for that mustache.
Here maybe, but
no, I mean in the stock.
No. Yeah, I don't know, man. It's just not an area. I just don't care about, like, pharmaceuticals is just a thing that, like, I'm sure there's tons of money in it. It's such an industry, like, it's such a learning curve that I do not want to try to tackle. It's so big. And what I'm like, there's industries right now, like cybersecurity, which I'd rather try to figure out and learn, that I think are guaranteed to have lots of success. And I'm not saying you guys can't make a lot of money. I'm just trying to be focused in a couple different sectors.
And there's a lot of risk, but a lot of risk, a lot of reward. I don't think the risk is as bad as many think, though.
Let me ask you guys this. What's one stock you're buying and one stock you're selling? And Tanner, before you say I'm not selling anything because I'm Tanner, you don't have to actually be selling it, but it's a sell for you. Like one thing in your one thing maybe not in your portfolio, but that you're looking at, that's a sell for you.
Okay, I got my answer. A buy for me, Nvidia. I think it's it's getting to a place where it's going to be like another amazing S curve. I think that this stock is going to be explosive. Sell in my portfolio. I mean, I'm still not a big fan of Unity. I don't know why I got into it, but actually I do. But I'd get rid of that.
January 1st, right? As soon as
you know what's crazy? That is the indicator to tell that the market's bullish, is that Unity is starting to move, and I'm like, oh my, sell everything.
Dude, everything. You need to keep a share, and it's your canary. You know, like they used to carry canaries into the coal mine, just like, and when it died because of asphyxiation, all of a sudden they're like, hey, it's time to get out. So keep that one share, keep it on your radar. And maybe even double down when you're like particularly thankful as far as the money that Unity has saved you by using it as an indicator. You know, have 2 shares. Go wild.
Yeah.
So mine, it's Nubank is very attractive. I actually doubled my share count position this week. Doubled it today, actually. But I'd say PayPal, like what they're doing. Did you see my tweet that they're number one in the App Store right now
No.
for finances? Yeah.
That's interesting.
And
First
you know
time in
what?
a while.
That is I switched my answer. My real answer, what I'd sell, and I mean what I would dump is, and I probably will sell next week, is Block.
Whoa.
Yeah. It's extremely disappointing, their user growth right now.
Oh yeah.
One of the things that has always held me up is saying, you know what? Everyone can say what they want, but in terms of user growth, they've always known how to attract users. And then they said, we're not going to go international. We're going to stick at home and we're going to double down. And it looks like they're not even doing that. So they're getting a lot of price appreciation because of Bitcoin right now. And I think I should take that as my advantage to get out. That's my way to secure some gains. So if I trim, it'll be 50% of my portfolio. If I get it'll be a lot of that position.
That's really interesting because I remember back, I don't know, 6 months ago or so, like you were advocating for Block because of the
Was
cash
loving
app.
it.
Yeah.
Was loving it. And then the last quarter, they dropped their average profit per Cash App user, which they've never done before, which I see signs like that. Like same thing with Robinhood, right? Robinhood was going along from $8 up to 17, and I wasn't seeing anything I was liking. And then it clicked, and I go, oh, okay, well, I don't care that I'm buying at the highs. I believe it'll keep going because that is a turning point. But the same thing is happening with Cash App, where this is a turning point. And I don't believe in them for I think Square, what I really liked about Square, I've never been super bullish on Square. What I've liked about Square is the cross-sell to Cash App. Okay, so I think that there will still be that. They'll create a good ecosystem there. But I'm just, Cash App was the grower. So if you don't have the grower, and Square's not doing that either, and now what? You're going to go all in on Bitcoin, and your bit keys aren't even selling either. It's like, I don't know. So
yeah, I mean they have no cash holder, no appreciation for the cash that shareholders give them. Just buying title, Affirm's fine. Like I had no problem with that purchase because they did it with stock, and stock was very elevated. But
Afterpay.
Yeah, like getting into Bitcoin miners, like what? Yeah, Afterpay. Thank you, not Affirm. If they bought Affirm, like watch out. By the way, Cash App is now number 2. So it was number 3 for a little while because of weird stuff with Credit Karma. They have a lawsuit they have to pay out on. I think people are checking that platform. That's also part of the reason why PayPal is a little bit popular right now. In that settlement, you have either checks that are mailed to you or PayPal. Those are your 2 options. I mean, like so many partnerships going back to PayPal. Fastlane, is launching well. I think they're going to have a lot of the market. I don't care as much as the market does on active users, although it is pretty important for the marketing aspect, not the marketing, the advertising platform that they have launching. But the advertising platform, early indications are, I think that will go very well. They picked the absolute right guy who, I mean, this isn't PayPal Weekly, but if you look at just the share price and you look at Q4 earnings, to be like, yeah, it's a good value. And quarter three earnings. And Q3 earnings were the worst this year. They were good. They weren't amazing. But like what they're actually building and what they're capable for in the near future, especially what they're launching, which is all margin accretive, and they'll grow top line and bottom line revenue very, very rapidly. And they're buying back shares. And I also think, although it doesn't matter much to me, that they will start out offering a dividend here in the next maybe 18 months. It's got a long climb to go up. So yeah, I'm buying a lot more PayPal.
I wouldn't mind a tiny Nvidia-sized dividend. So then dividend funds can, look at them and say, hey, this actually does fit into our portfolio the way that some dividend companies would put Nvidia or Microsoft or something like this into their portfolio. But I actually I'm not a fan of dividends. Like just personally, just because maybe my age or time horizon, I just prefer buybacks are so much more peaceful on the stock. They add nothing but positives. And like canceling buyback programs do not have the same effect as canceling a dividend.
I mean, I get it. I like buybacks as well, but you always have to like sell the stock to capture the gains that a buyback gives you. And realistically speaking, well, he's not doing covered calls right now. So it's like dividend is cash in your pocket, which you can choose to reinvest in that company. You can choose to buy call options. You can choose to buy another company. You can choose to take out and take your girlfriend out to dinner. Like you could do so many things with that dividend money. Realistically speaking, you're never going to sell that stock just because Apple announced buybacks and Apple's stock price increased 10% because the company is buying back shares. You're like, oh, cool. Let me sell 10% of my Apple because of the buyback. So it's
you
a different.
Can, though.
You can absolutely, but realistically speaking, an investor like yourself who is long-term focused is not going to do that. And so the tangible benefit is that dividends is money that you can spend versus buybacks is just great, more appreciation. I don't know.
I get the upside to the problem is that if a company goes through hard times, I just think there's more flexibility with a buyback. There is one-time dividends. That's a real thing. Like special dividends, you don't see them very often, but you see them from time to time.
Yeah, where you get a special dividend this year.
Yeah, like they do happen. But what's it called? I just find that whenever you cancel a consistent dividend, that it has a drastic impact on companies because it completely changes people's like once you start getting into 5 years of straight dividends, then you start getting placed into like dividend growth companies, like then you have like it's honestly not advantageous to the company. It's almost an extreme liability that somehow they have to continue to increase this dividend by at least a penny. And I just find sometimes companies will kill themselves to try to pay a dividend that they've signed themselves up for 30 years ago.
Yeah, I mean, but on the other side too, with buybacks, sometimes companies will offer buybacks far earlier than I think that they should when they can use that money because they're in that high growth phase instead to just generate more revenue. If they have a lot of cash like Robinhood, it's a relatively small buyback compared to their cash. They're very profitable right now, so that's fine. Like they're not hindered by a lack of cash. They have no debt, which is amazing. Versus like HIMS, that's one of the drawbacks. Like they have a buyback, but it's a small buyback, but they don't have a ton of cash on the balance sheet. Like they're positive. I don't believe that they have any debt. You might correct me if I'm wrong, Tevis. Not any meaningful, at least. But I feel like that they could HIMS. I feel like that they instead of doing the buyback, it would have been better that they just use that money to grow more aggressively. And their marketing spend, their strategy, it works. So there's a drawback for both. Now, the one thing that I'll say with dividends, and it's one of the reasons why I was kind of paying attention when my family, mentioned Nike this weekend and how busy it was, which it was on Wednesday. So it's like, it's a little bit unusual. It's not meaningful, but it's just an observation that I'll throw out sometimes. But I'm probably going to take a look at Nike this next month. My natural bias is I think it's going to take years for them to turn around. That they probably will. They hired the right CEO, but there's several things that are attractive to it beyond valuation. One of those is, and probably the most significant, as bond yields fall, then there's going to be yield chasers. These are people, unlike yourself, Tanner, who either are like really old and they don't need the risk of being in a growth stock. Like they don't. If I'm 70 years old, I want a boring dividend play. I don't want Palantir at all. Like I wouldn't touch it.
My dad doesn't want a company that doesn't pay a dividend.
Yes.
And guess what? Your dad doesn't wear On Running shoes or Hoka's. He knows Nike.
Yeah.
No, I'm not. I get it.
Yeah, and I'm not trying to like push Nike here. Like
and he knows PayPal.
Yeah, but no, that's the thing is usually these dividend companies are long-term names that attract people that are in their 60s, 50s, whatever, that are retired or close to retirement, or are much younger but have considerable amount of wealth to the point where they'll invest in real estate and venture funds. But a lot of what they want to invest in is just boring, stable stuff. They don't even touch it. They just have an investment manager do that. And that's exactly what they look for is those stable dividend stocks that are good companies that are growing like 3% per year, 4% per year, like at US GDP levels. So I think that there's going to be a concerted push as long as rates fall as they're expected right now or something close to it in this next year, in the second half, that people say, you know what, I was making this on bonds. I need to start with it as things continue to fall. I need to find something else. So all of a sudden, like in the second half of the year, a lot of the dividend names, which some of them have run, but a lot of them have not. That's, I think, when we're actually going to see a broadening out of this rally as things flow from, high moving tech. Not that it'll not necessarily sell off that much, but as those bonds flow into just stable, boring dividend stuff. Yeah. Maybe that's Nike. I don't know.
I agree with that. And the thing with Nike is that they're so beat down that, yes, it might take years for them to fully come back to growth mode if they have, like, if they sponsor the next Michael Jordan, or if they get the next, great shoe line or whatever it may be, or if they do it through an acquisition. But from a market perspective, all they need is like a hint of positive guidance, and people will jump back into the stock because it's the sign of a turnaround. And we know that the market always front runs that kind of stuff.
Someone brought up the fact that NVIDIA pays a dividend. I'm of the mindset, by the way, because I said I don't like a dividend. I love NVIDIA. I'm of the mindset that Jensen is on a higher, he's in a different realm, okay? So he doesn't want to offer a dividend the way, like to treat shareholders. What I really think he's doing is he's allowing portfolio managers that have objectives to place them into different portfolios. I sat down with a Fidelity portfolio manager back whenever I was working as a financial advisor, and he told me, like, NVIDIA is our big value play. I said, well, it is a growth stock. And he goes, no, it's a value stock. And I was like, what? But that's how they can justify that through, these types of things to say, hey, well, we can have it in our exposure in our growth thing. We can have an exposure in our value plays. We can have an exposure in our dividend plays. This is why I believe that they offer just the tiniest dividend, is just to get the broadest, indexing of their company.
Yeah, no, they and that's really, really smart. Like PayPal probably will start. I hopefully, if Alex, Chris, if you're listening, just let me know, and I'll give you some advice on this. But just start small, 5 cents per share. Just like, or even NVIDIA level, which is, it does essentially, if you're buying that stock, unless you're like, I will only buy dividends, or your fund bylaws, I think is the wrong word, says you can only buy dividend fund stocks, like you don't consider it having a dividend, but a lot of people do at any dividend. It's not even the yield. So
your fund's objective.
Yeah. Well, and so to be fair, so part of that isn't just like stupidity or being boxed into legal stuff too. They realize that most companies, they start off small. They'll give, maybe a 5 cent, 10 cent, dividend, or, it's like a 1% yield maybe. But those tend to grow over time, as growing companies do. And so there's, out there dividend kings that have throughout, I forget how many years, it's multiple decades, have continued to either maintain or raise their dividend all the way through, to the point where, in a decade or two, you're getting every single quarter in a good company, ideally, the same amount that those initial shares were worth. That's fun. It probably underperformed relative to the market. Dividend names are not the most exciting, but I mean, there's exceptions like NVIDIA, good old value stock NVIDIA.
Value stock dividend play. Old 70-year-old people can buy their dividend stocks comfortably in NVIDIA. Which, I mean, they're not even complaining either, because they're wondering why the overall value of their dividend stocks are going up. Which, if I was interested in anything dividend, it would be dividend growth, but why even? And there was someone that brought up the fact, now I think he worded it incorrectly, but the idea that stocks go down whenever dividends get paid out, it's not exactly true. But the idea that, the company's enterprise value does get affected whenever a dividend is paid out is true, right?
That's true, yeah.
Cash is being taken out of the business. So if you see payout ratios, and some of these are extremely high, it's like, yeah, no wonder the company can't continue to grow, because they're just taking all the cash that they possibly have that they've made and just shelling it out each quarter. And so, this is why I think buybacks, dividends, it's all the same thing. I don't know. I just like the flexibility of a buyback. That's all. And also affects your EPS, which makes earnings revisions happen, which makes Wall Street potentially a little extra bullish. What's it called? Are there any other topics, or let's actually, do we just want to wrap? There's no other topics. Let's stay on schedule for once.
Congratulations, SoFi shareholders. It's been a long ride. It's been good. I think this is a beginning.
You just said we're due for a pullback.
I have long-term horizons. I'm not worried about what's happening over the next 3 months. That's why I'm not selling.
Yeah.
Well, I mean, it's worth calling out that 18 is fairly strong resistance. So we might see some chop around that level. I think that we will.
I'm not seeing that at all. Every single time that I look at the chart, it says it's going to go above 19. I have my Tevis indicator. It's screaming for 19.
Well, here's what I will say. If we break 18, then it's going to be a quick trip into the low 20s.
Well, I mean,
yeah,
feels like we're guaranteed 19 though. So, I mean, self-fulfilling prophecy.
We will see. But my price target still remains $20 end of year, just what it was in January of 2024.
Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time.
Bye for now.
Oh, I don't know why his camera's